Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Marc Ostwald, who's a strategist at ADMISI. Thank you very much, as always, for coming onto the show. Let's talk Brexit. Obviously, getting a lot of headlines. There's a lot of talk about what the bill is going to be. So first off, what do you think it is? Secondly, does it really matter? And what does this mean for the UK as a whole?
Okay, I think there are some more optimistic signs. We've got, there were always three issues. We seem to have resolved the one about citizens' rights. That seems to have been resolved for quite some time. The Brexit Bill, which we shouldn't really call the Brexit Bill. I think that the problem with calling it the Brexit Bill is it's a failure to put it in the right terms. There are liabilities which the UK has incurred over time, and perhaps the best analogy is either, say, going into a lease finance agreement for a car, or perhaps buying a new telephone and signing up for a 2-year contract. If you decide to terminate your lease, then there are monies to be paid, as we all know.
Yeah.
It's really no different to that. And so talking about this and the very heated language which is used in the media and the fights between Remainers and Leavers seems to be a lot of wasted time. And I think that's really where the heart of all of this lies, when one thinks that it's been almost 18 months since we had the referendum.
Yes.
It's been 8 months since we put in the Article 50 letter, and we haven't actually progressed very far. And it seems to me a lot of time has been wasted with posturing, with people talking at each other rather than to each other. And we could have got to where we are now quite some time back, and given more breathing space for dealing with some of the big issues. Now, for instance, the third issue in all of this, obviously, is the Irish border.
And I think that's very serious, and that's something
That
should not be rushed.
Yeah, it's not something which should be rushed, correct. And it is very much part of the bigger trade picture, because if you actually look at it in terms of the common agricultural policy, the money that Northern Ireland receives as part of the UK's total is about 11%. However, if you did it post-Brexit on the basis of a population assessment of where you provide the subsidies, it should actually only be 3%. So there's an issue there. But let's start with this whole border issue. The UK government obviously will not sanction anything which leaves Northern Ireland in the customs union and in the single market. As Sir Christopher Meyer, the former ambassador to the US from the UK, suggested the other day, well, the simplest way is to move this on is to just swap the definite article, for the indefinite article, a, and suddenly you have ability to move the whole conversation on. It's not actually particularly challenging, that one. Now, in terms of moving on to trade, what worries me in all of this is it's a very complicated issue, particularly in the area of agriculture. And we've already seen the noises coming stages of. Ironically, it's one of the areas where the UK, or where Westminster and Brussels, basically on the same page of the book. They basically like to carve up the existing tariffs along the lines of usage at the moment and be done with it. Obviously, the rest of the world, particularly the big agricultural exporters, including the United States, Brazil, Argentina, Australia, New Zealand, so we're talking about some serious players here, are all objecting to this rather comfy carve-up that's going on, because they are obviously particularly worried that you may actually see where the quotas are allocated to one country. If demand suddenly falls off, they're still tied to the quotas, and they would naturally not have the same access as they had actually in theory before. And that is going to be very, very problematic, because it's not just some comfortable carve-up done between the UK and the EU, even if it is an area they agree on. That brings me on to the next point, which is that the model being touted at the moment, apparently, as our template for the negotiation, assuming things get moved on on December 14th, 15th, is the Canada one. Now, there's two ironies in this. First of all, the Canada trade deal doesn't cover financial services, and financial services are obviously critical
Yes.
in all of this. And talk about equivalency under MiFID II is all well and good, but there are all sorts of other issues to do with the UK not being in the EU, and therefore where would Euro clearing go? Secondly, if you actually look at EU-Canada bilateral trade, and then you look at EU-UK bilateral trade, just keep it to the physical goods side,
Yes.
even though the financial services, there's no comparison. I mean, it's just, there's no similarity, so how that can be touted as a template, I don't know. And which brings me to the final point, is we've wasted so much time, and there are only about 15 months left. I really, truly hope that they can move things on, that they get over these first three issues, as appears to be the case. But then I'm wondering how on earth they, in the time allotted, given the amount of time that's already been wasted, they can actually come to agreement by March 2019. And that is really going to be a major, major challenge. It's not saying that none of the problems are insuperable or even intractable. It's just saying that time has been wasted, and none of the issues which are going to have to be dealt with in trade terms are going to be easily solvable. It's not just simply saying, oh, well, we'll just carry on doing it as we are.
And just finally, the pound. We've seen the pound strengthen on the back of, there may be a deal on the table that both parties agree to. Is that move higher because people are saying, well, actually, we can now start to address these issues you've highlighted, or is it the market just really not reading it correctly and getting a bit ahead of itself and saying, well, is it a good deal, bad deal, regardless of that, a deal is a deal, and let's just get on with everything?
Well, I think there was a lot of negativity surrounding all of this, and a lot of negativity, particularly post-budget, after we had the OBR forecasts, which were pretty pessimistic,
Yes.
in terms of the prospects for the UK economy. So what I'd say is, first of all, a lot of the move in the pound is you can't be seen out of the context of what's happening with the dollar at the moment.
Very true.
So a lot of that supposed strength is not necessarily a more positive attitude to the pound, but rather an increasingly negative attitude towards the dollar. Nevertheless, if one looks at it, what we've seen also is it's been fairly well tied in with the upward move that we've seen in UK 10-year yields. However, if we're going to provide some context there, then you go, well, what all we've done is in fairly short order, and in a market which isn't moving very much, which is the most important part, so it looks like a very, very sharp movement. But we've gone from the bottom of the 10-year gilt trading range towards the top of it, but we're still in the same range we've actually been trading in. And likewise with the pound, what one has to think of is above us is this 136.50 level, which is absolutely key. That was the level which we fell from, and going through this effectively what is 100% retracement level is probably going to be more of a challenge, particularly as the news flow that we get is going to continue to be quite mixed. So I think for a lot of people, and particularly when one looks at overall positioning, I was surprised by the sharpness of the move, but then I looked at it in the context of the dollar. I was surprised primarily because if you look at the commitment of traders data, basically it says the market's pretty neutral. It's not like the situation we were in back in March, April this year, where there was a massive 110,000 contract short. Basically, the position is neutral. Obviously, there are shorts out there who can be squeezed, but I'm not thinking at the moment that we're really in a situation where the Bank of England, which is going to obviously be key in this, is going to be looking at the Brexit negotiations saying, well, probably we should be thinking maybe in February about instituting another rate hike. That's certainly not the noises we're getting from them. And as long as that's not the case, then perhaps this pound rally, as a pound rally as opposed to dollar weakness, probably doesn't have a lot of strength to it.
Understood. On that note, thank you very much for joining us today.